Hello, everybody. Thanks for joining us today. Welcome. My name is Michelle Benjamin from Leasecake. We are here to talk about growing efficiently with our special guest. And before we get into the actual content and the introductions, just a few housekeeping items while everyone is joining. We are recording this and we will be sharing it out with everyone afterwards, in case you want to listen again or later on. And if you have any questions, we would love this to be interactive, so feel free to send them over. You can do that either through the Q&A or the chat box. We'll be keeping an eye on both of them, and we welcome your questions. We'd love this to be interactive. So with that, I will pass it over to Taj, and he can introduce our speaker.
Great. Hey, everyone. Welcome to today's Leasecake Live webcast. Thanks again, as usual, Michelle, for the great introduction. We are here in the education business. This is what we're about. It's important for us to share ideas and stories and advice across the industry to ultimately help you improve. We definitely, as Michelle said, want to keep this interactive, and we encourage questions even during the program. We're not here to wait until the last 15 minutes for sure. And frankly, it's a lot more fun that way too, to keep it interactive. So it's how our team is wired. And my name is Taj Adhab, and I'm the founder of Leasecake. And we are coming to you live from Winter Park, Florida. That's just a little north of Orlando. And no, this is not a backdrop. We've got our cake quarters here. We think the best conversations are the ones that are held around a kitchen table. And frankly, that's really the launch of what Leasecake is all about. So we're here for you. We serve tens of thousands of locations in our system, hundreds of brands, and we're real estate and location management made easy. For restaurants and service-based retail, we reduce your real estate risk, protect your locations, so you can focus on growing your business. And on that note, and no stranger to growth and acquisitions, Cal Gulabali, welcome.
Thank you, Taj. Thanks, Michelle, for having me. I'm looking forward to having a good discussion.
Absolutely. Well, so you are, I think, one of the role models for acquisition and growth. And, with our headline here, Mastering Growth, Strategies for Scaling, why don't you start first with your story? How did you begin? Get started with the brand. Tell us a little bit about your background.
Sure. So I after college, I worked on Wall Street for about 7, 8 years. Those are my dark days, but enjoyed the opportunity to learn a lot during that period of time. But knew my calling was in small business. So after leaving around 2010-ish, 2011, I actually owned a bunch of independent businesses. So from butcher shops to independent pizzerias to a burger concept that we created in Boston. Kind of did the gamut of independent food service operations, but then realized that I was gaining a lot of weight, and so I joined Orange Theory Fitness as a member, and became very friendly with the owner, who actually to this day is a good friend and business partner of mine. But we weren't partnered at that point. He just was kind of walking me through the financials of franchising, and in this case, Orange Theory Fitness. And I was really curious, learned a lot, and I said, "Hey, you got to find a way to get me in." And so he was able to put me in touch with the right people. I was able to secure 2 licenses in the Boston area, and we opened those 2 locations in 2017. At this point, we've exited from the brand, but that's how I first got my first start. And since then, I've joined a bunch of other brands: European Wax Center, VO Med Spa, Marco's Pizza, Dave's Hot Chicken, and Restore Hyper Wellness. So passive and active, we have about 120 units in about 8 states, and I currently reside in Tampa, Florida.
Well, that's a great background. I just love the fact that you're not just a multi-unit operator, you're a multi-concept operator, testing and exploring. What are the steps that you look at as you acquire? I mean, I can't imagine asking you this question, like, what's a day in the life of Cal? Because I'm sure every day is different. So why don't we start with, like, how do you choose which brands you're going to bolt into your portfolio?
Yeah, good question. So, generally I started in the health, wellness and beauty side, with Orange Theory and then European Wax Center. And then, really VO Med Spa. But when the pandemic hit, a lot of the service businesses, particularly in the Northeast, got crushed, and they didn't recover as quickly as we want them to. And so that kind of taught me that I needed some diversification. And what do we see during the pandemic? Well, we saw food service operators really excel, right? And those specifically tied to delivery and carry out. So at that point, I knew I wanted some diversification. I joined Marco's Pizza and Dave's Hot Chicken so I could create this kind of balanced portfolio. But when I look at brands, I'm looking for, generally speaking, I'm looking for brands that have scale. There are a few brands that I've joined that are on the infancy side, but most times I'm joining brands that, have several hundred units in operation, franchisees that are generally happy and making money. Because it's really important to, buy into a brand that has a proven model. That's why we join franchises, right? So that they have systems and processes that we can implement and scale, so that, there's money flowing to the bottom line and we can produce an ROI to whether it's ourselves or our capital providers.
Yeah, that's great. And congratulations on getting, named in the top 200, because that's all about, like you said, having a profitable business, adding on brands and having that flow to the bottom line. So what ranking are you?
In the last one, it was 200, but I don't think the 2023 rankings came out unless I missed it. But yeah, in the last one, we kind of just hit that 200 mark. So we
Well,
barely got in.
Oh man, but congratulations. That's a great testament. We've got several customers that are in that grouping. So I'm sure next time we chat, you're going to be, 195 and then 150, keep growing.
Yeah, hopefully in a couple of years.
That's cool, man. So the decision point to get into, let's just talk about VO Med Spa. What's particular about that brand? And we'll certainly talk about, Dave's and Marco's, but curious how you look at that business.
Yeah, when I was scaling European Wax Center, increasingly I kept hearing the word Botox, injectables more broadly. And when I started surveying our wax specialists, right, the folks that are putting the wax on our guests and pulling it off, the typical profile of a wax specialist is mid-20s, right? And so I surveyed them and informally asked them, like, are you doing Botox on the side and whatnot? And most times, most folks in the mid-20s were doing injectables, so they're getting those services to themselves. And I was very curious about that. So one of my cousins is a dermatologist, and I asked her, I said, "Hey, is this common now? Is it, because I keep seeing the pie of injectables continue to grow." And she said it's very common, and now it's people are doing it more preventative. And so as I leaned in there and did more, research, talking to other med spa professionals, I was looking for a franchise because, I'm, all my investments are in the franchise space. I was looking for that franchise that we could partner with, and VO was that. And so, if you could get a piece of the med spa industry, which is growing, and more entrants are obviously coming in, but if the pie is growing, that's a good thing, right? You can have more entrants and more competition. And VO at this point, if you kind of look at med spa franchise, it feels like they are winning and going to win that category.
Great. How many VOs do you have?
So we have 2 open now. We opened them both in the last 2 years. We have 2 under construction, with 1 opening in late June. So we'll have 4 by the end of the year. And then we're going to open up 2 to 3 a year, and without not including potential acquisitions.
Got it. Is it hard to identify retail space, or maybe identify or secure retail space? Because maybe those footprints are similar to, your pizza and chicken operations.
Yeah, it's still a little different than restaurants. When you look at like VO Med Spa or European Wax Center or even Restore Hyper Wellness, the 3 kind of health wellness beauty brands that I'm in, those are all kind of looking for that same customer, right? The customer that's, looking for that higher end consumer experience near the gyms, near, say, the massage, like call it the Massage Envies or the Hand and Stones, right? They're looking for that type of consumer that near the Whole Foods or a shopping experience, the higher end lifestyle strip centers, where you're able to pay a little bit more premium for rent. But you have that customer coming in that has a good amount of disposable income and really caring about their own health, wellness, and upkeep on a daily basis. So it's a different type of retail. When you talk about food, and you're looking at Dave's Hot Chicken, you're looking at high, prime on prime. So you're looking for out parcels, right? Freestanding units, sometimes end caps, never inline, and really premium spaces that you would kind of see a Chick-fil-A in.
Yeah, that makes sense. There are some smart operators like you that are saying, hey, I've got a great location here as a Marco's Pizza, for example. But if a space opens up in that retail center, it's so much easier to just kind of bolt that on because you're getting more of the consumer's, I guess, wallet share and mind share. But you're kind of front and center with potential retail openings. Are you seeing a little bit of that? Because I know it's hyper competitive.
Are we seeing more vacancies? Is that what you're saying?
Yeah, potential vacancies where you can kind of be first in because you got a relationship with the landlord, and et cetera. I don't know if
Yeah, yeah, definitely. With some of these bigger brands, they're doing a great job, especially when you have a great CDO, Chief Development Officer. They're
yeah.
building the relationships for the franchisees. As a larger franchisee, we do have some relationships, but it mostly comes through the franchisor. And the best franchisors are already going to these, regional conferences. Like there was one in Vegas a couple of days ago. Maybe it's still going on, but definitely it was over Monday and Tuesday, and all the big landlords are over there, networking with the franchisors. And so we already, we received a few leads from that conference about, Dave's Hot Chicken and VO, so that we're looking, then we'll start vetting those real estate opportunities to make sure that it fits our brand. And, a couple of things that we're looking at is who are the co-tenants, how many vehicles come there, what type of customer comes there on a daily basis, how often do they visit? And hey, if there's good co-tenants there, what are their sales? That's a big indicator of future success.
100%. Then because you do extensive due diligence and surveys and kind of market research, right? Um, have you kind of codified that into your acquisition strategy? I mean, is it just Cal and a super smart team of people? Like, how are you looking at
Yeah,
leading?
it's definitely not just me.
Yeah.
I'm maybe the weakest person in the room, but I have a great team. We're always hands on. We're looking, especially when it comes to an acquisition, we're going into the store to make sure, or the spa or the studio, to make sure that is this a good real estate play? Is it an operational issue? Is there areas for improvement? We're looking at everything when we come there, and then we're looking at the lease, right? We're looking at the lease abstract to make sure that, it's there's enough term that's existing. Do we need to make adjustments or modifications when we, talk with the landlord? And so all that comes into consideration, especially when we decide or not decide whether we want to put a bid out for said acquisition. And then if we do, what type of modifications we have to make so that the acquisition makes sense. And like, for example, we're going through an acquisition right now. The term is 7 years, right? And so we're going to the landlord and saying, hey, we'd love to take this over. We're a proven operator, and we'd love to add 2 more 5-year options to the back end, so that we can be a long-term tenant of yours.
And are they generally open to that, or they want to renegotiate because you're a new buyer?
I think in this day and age, in 2024, there's price risk that landlords don't want to commit to. So in the past, I've had the ability to go in there and say, hey, I want 2 5-year options added to the back end of the lease, and we could actually just pinpoint the price. But I think with what happened with COVID and inflation, I think in 2024, the best we're getting is, yeah, we'll give you the 2 5 years, but you may need to give me a little bit on the front end so that we can maybe go up to market. And then number two is we're going to go to market rent. We're not going to define the price on those 2 5-year options.
Wow.
So it's changed a little bit because nobody wants to just say that's the price. And I get it, because I'm a landowner as well on a commercial side. And what if prices should be much higher, or rent rates should be much higher, right? That reduces your transact. If you lock in a very low, square foot price per square foot, and you say you want to sell in 10 years, but you have this, this cycle of low base square foot price, the property is going to trade on the rental income received.
Right. Right. when you're acquiring, because you were talking about leases and the kind of M&A due diligence process, how many locations, what's the biggest number that you've acquired? Is it one or two at a time, or what's the biggest acquisition you've had so far?
Yeah, the biggest acquisition we've done is 17 units in Marco's Pizza. We've done a lot in the 5 to 15-ish area. We've also done as low as one or two. I actually find the one or two store acquisitions a lot harder because there's no regional manager, or it's a different type of culture with the one store acquisition, very hands-on owner operated. So we tend to like to be between 5 and 20. It
Yeah.
just, it's a lot easier. We've had a lot more success with the post-acquisition operations.
Yeah, right. Well, congratulations on that. I mean, it's a huge lift. I mean, you've got there's the cost of capital, there's bank financing and all that. You got to package it up. So phenomenal that you were able to do that. What are your any tips or tricks with successful acquisitions of the larger size, let's just say? I know you said they were easier, but what are the things that you want to do more of? And
Yeah, I mean, I think the most important thing when you're doing these acquisitions is making sure that you're talking with the seller, the selling team, like the key stakeholders before the acquisition happens, and just laying out the calendar of how the acquisition looks post-acquisition and making them feel comfortable. If you get those guys bought in to, hey, I'm not going to rock the boat early. Hey, there's going to be changes down the road. I mean, it's very important to be transparent about that. But in the interim, look, we're not going to rock the boat. We're just going to fold you into our company, and this is how our company operates, and get them to buy into that. The transition becomes a lot easier.
yeah, that makes sense. So basically, you're a large multi-unit, multi-concept operator with a team. Actually, there's a question that just came in. It's going to be tied to this. And your greater success or ease is talking to other multi-unit operators that have some sophistication in terms of their team and process. So a question here is, as it relates to your own back office infrastructure, you talked about it. You say you're the weakest link. You're not the weakest link, I'm sure, but you're humble. That's what I love about you. How big is your team? And then let's talk about outsourcing in a second.
Yeah, so we have a robust org chart, right? Depending on the brand, I'll speak specifically to my food side, that operates the umbrella of Dayside Chicken and Marco's. But I've got a VP of Ops who handles all the operation side, and actually marketing rolls into him. But he has people underneath him. He has about 4 or 5 direct reports.
Yeah.
Someone that is in charge of the office. We have an HR department that's pretty lean, has 3 people. And again, this is just the food side. But and then we have a finance department, right? I have a CFO. He's actually my global CFO. He oversees the entire the 5 brands. And we have underneath, our CFO is 2 in-house folks that are handling accounts payable. And I think, Todd, you're going to get to outsourcing. So I've done both. And there's pros and cons to both. And I would say, and let's specifically just touch on finance here.
Yeah.
If you have a great CFO, it's phenomenal to keep everything in-house. But a phenomenal CFO is very tough to find. And especially if you're doing a roll-up strategy or an acquisition strategy, your finance team is always going to be behind. And so you need a really good financial team to keep everything under control, because the sheer amount of volume of paperwork, of application work, of just making sure the books are clean when you're doing, say, 15 acquisitions a year, it's a lot of work, and it keeps the finance team under a lot of stress. So if you don't have great leadership there, I would certainly consider outsourcing.
Sure. That makes a ton of sense. I imagine, though, like you had mentioned, it's really hard to find a great CFO. But in the early days, did you outsource your bookkeeping or your accounting, any other functions?
Yeah, everything. We generally speaking, it depends on the brand, but there's always some outsourced bookkeeper slash firm that would be in the know in that particular brand, and they could keep everything under control.
Yeah.
Specifically in Marcos, we tried that, and this particular outsourced shop wasn't able to keep up, and which is why we then moved everything in-house.
Got it. Got it. No, and listen, from an audience perspective, that was a great question. So thank you for asking that. Please keep them coming. So then there's this point in time where you just said, okay, now we shouldn't outsource, we should bring it in-house. Like, what was a specific moment for you? I mean, I think maybe you touched on it, but how many units were you up to at that point where you said, let's not do outsource, let's go in-house?
Yeah, and again, it depends on the brand I'm in. So we still have a hybrid approach to this. Like for example, in my former company at European Wax Center, when four, we were at 20 locations, everything was outsourced. And we actually had a pretty good outsourcing team, but it wasn't good enough to handle what we were about to go through, which was go to 47 locations. And so we hired a phenomenal CFO, and he brought everything in house. He built the team underneath him. And I mean, if I told you every time we got a quarterly or monthly presentation, it felt like all the numbers were buttoned up. Everything was just perfect. And you had a lot of integrity to the numbers. And so, what you were looking at was good.
That's great. Good to hear. It's so hard. I mean, when we're talking to CPA firms all across the nation, it's so hard for them to find even CPA candidates, right? Students that are graduating college. There's like 300,000 open positions. So speaking of really great CFO, CPA leaders, like it's super hard to find them. It's going to be probably even harder. So I'm glad that you were able to identify someone, and ultimately it helps you sleep better at night.
Yeah.
What are some of the pitfalls of things that you should avoid, or any specific pain points that you want to share examples of, like, oh crap, when I acquired some brand, don't ever do this. Any ideas,
Yeah,
examples?
I think it's, when you're acquiring a couple different locations, it's really important to vet the team in place. I think, there's a bunch of operators on this call right now. I think we all can agree that, the manager makes or breaks the location. I mean, hands down, that's it. The manager is everything. And so when acquiring locations, we got to make sure the infrastructure at the field level is strong. And if it's not, that should be reflected in the price. Because we've taken over, we've made a lot of mistakes. Don't get me wrong, this has not been a smooth journey. But where we've failed is when, acquisitions didn't have the right infrastructure, and we might have overpaid for that. And so that's where I have regrets. And I did want to give you guys a plug here, because some of the issues that we've also dealt with were leases. And before, and I don't know if the everyone here knows this, but we are a client of LeaseCake before I met you, Taj. And one of the things that was frightening, this was back in 2020, so right when COVID happened, a landlord came up to me and said, "Hey, by the way, you didn't opt in for your lease, your next option." Um, and I said, "Oh, shoot." And at that point, this was, kind of during just like maybe the third quarter, fourth quarter of 2020. And, things were starting to come back. And he knew that he knew that he had some power there. So he leveraged that power. And he said to me that, "Hey, we have another tenant that wants your space, or another prospective client that wants your space." And he certainly used what he had to. And so a lot of sleepless nights, because that was a very good location. It was about a million four top line, 27% EBITDA margin, European Wax Center. So we couldn't lose that. And he got another $6-7 of rent tacked on to the lease. And that told me from that day on, I needed a platform to monitor this stuff. So when you talk about even acquisitions, to your initial question, I mean, it's just so important to be looking at these leases.
Well, thank you for sharing that. And we've heard this time and again. Some people are like, gosh, the landlord's got some power. And yeah, I was forced into paying maybe, 1 or 2 extra bucks a foot, but $6 a foot. You start to do the math, right? In the remaining term of the lease, 10 years and then 5 years. I mean, it could be hundreds of thousands of dollars.
Oh, easily, easily. I mean, that if we lost that, I mean, I gave you guys the math there. that's a $400,000 EBITDA location. EWC's, trade anywhere on our platform side, 8x, 9x, right? That's a big loss if we lost that location. Now,
Wow.
could we find it? Can we move it? Yes, but there's some damage to be done if you close down a location and reopen it, say a year and a half later.
Yeah. Especially with all of the build out that you put in, right? Whether it's the TI the landlord funded and you've built it out, it's all of a sudden somebody else is inheriting that space. You're like, crap. It's expensive all the way around. Um, let's share with us the ideas around negotiating a lease from scratch. Certainly you touched on renegotiating, but what are the things that you look for as a really good tenant friendly lease so you have a little bit more of that power?
Yeah, so I mean, I think most folks know that, we're looking at base, we're looking at term, we're looking at options. And those are the basic things that we're looking at. Then TI, and guys, hopefully you guys all know this, but TI is just a way to get extra financing. So you're paying for it in the lease. But one thing that we spend a lot of time and money on is actually the assignment language. In one scenario, when I first sold a portion of my European Wax Center franchise, and I still own it, but I sold a majority stake in mine back in the early or 2020. We were going through a lease assignment. So it was 7 stores that I was taking private equity capital on. And it was 7 stores that we were rolling into the new holdco. And one of the locations, which is Newbury Street, the landlord, and I offered the landlord everything. So I said, hey, I'm going to be CEO of the new company. I'm going to keep my personal guarantee on in the new holdco. You have nothing to worry about. 6 months later, and he kept dragging it on because he could, because there was no, this was not a lease that I had originally underwrote. This is a lease that was assigned to me, so I couldn't change it. But he held out. There was a time where I even said to the landlord, hey, here's $50,000. Sign the assignment. He wouldn't respond. And so COVID happened, call it March 13th-ish. That's when Boston shut down. I finally got him to sign this on March 11th. If this had gone on to say late March, my deal with private equity would not have been consummated, which was, in the 8 figures. So it's really important as you all think about, these leases, that you focus and spend extra money on these assignments and try to make the assignment as liquid as humanly possible.
Makes sense. A lot of people they just talk about lease renewals, right? Or certainly lease expirations. But I mean, you've hit the nail on the head. There are so many details and a lease assignment provision, the notice period. What are your obligations to inform the landlord of who the buyer is? All of that it's power play. Same thing with personal guarantees. I mean, you use this word liquidity, right? Your location is liquid. You want to elaborate on what you mean by that?
Yeah, so it's good that you brought in PGs as well. But that to me, that goes in with the assignment language, even though it's usually a separate addendum or document.
Yeah.
But we try to limit the personal guarantees as well, so that sometimes you can't. I mean, if it's a prime on prime property, you can't. But we've done so many different things. So first thing is I'm saying, hey, 3 years, I'm fully off. That usually doesn't work. But you have to have a starting point. And then I go to 5 years, and usually sometimes that doesn't even work. Right. And then we get to a point of, hey, so what are you looking for? And oftentimes they'll say, well, you don't have a corporation or anything. It's sometimes we only have one unit in the corporation. Right. And they're like, you don't have a corporation. Well, how about we be creative? When the corporation generates $1 million in cash flow or EBITDA, then it replaces me as a personal guarantor. And a lot of times being creative with that type of language does work. But overall, when I talk about the PG, the release of the PG, and then creating an assignment language, right? To me, that's all about increasing liquidity. What do I mean? Well, when you sell or you do some type of change of control transaction, you increase the likelihood of the transaction actually happening and hopefully getting your liquidity event and getting money into your door. Because if you don't negotiate these properly, landlords have a ridiculous amount of power that they're going to use to either stop or get more economics in the transaction in the 23rd hour.
Yeah. There's so many insights, man, that you have like just learned and sharing. So just as a refresher, PGs are personal guarantees. We've seen cases where personal guarantees have continued probably after like 3 or 4 transfers, where the tenant probably from 12 years ago, they probably still don't know they're a guarantor on that location. And it's like that whole trail. Of course, a landlord wants you to stay on it, but the fact that there's 4 personal guarantors is just nonsense.
So
So
I need to lean in on this topic here because this is as we're going through a stressful transaction right now. So
oh, shoot.
in one of the locations, we're in one of our concepts, we're growing from 1 to 3, and we're buying kind of a distressed acquisition, 2-store unit in Orlando, and in both leases, there's 5 guarantors, and so what I urge everyone to do, because this, when I come or someone comes to buy your locations, this is really tough to deal with. They have 5 guarantors. Usually the sellers want to get off, right? It's really tough for anyone to replace those 5 guarantors. So if you choose to do 5 guarantors, just know that you're going to stay on in perpetuity, like you just said, Taj, and you don't know how long it's going to last. Because once the landlords have you as a PG, has your PG, and say you have 4 other partners, even if they're silent, they're not going to let that go.
Yeah. And then you're negotiating leverage. I love the fact that you've had a creative response, which is, once I hit this much revenue, please release me. Sounds like a song, right? Please release me, let me go. But tied to that is the question around percent rent. Are you seeing a way for you to gain some strength, or maybe another way of creatively financing your location with a percent rent deal with landlords? Is that happening? This is a question that just came in.
Yeah, I actually have never signed a percent rent deal. Obviously, there's been negotiations back and forth where the landlords wanted that, and it's just like it's a point where I just say, no, I'm not going to sign that. So, or, look, I've had friends that do it because there's a certain landlord that every single tenant in that shopping center does it, so they're not going to get away from it. At that point, you just have to figure out what's that break point, right? If the system average of this particular brand that you're in, and let's just say it does, the average store does $1.5 million, well, try to get that break point to 2 million, right? And at that point, every dollar you give another 6, 5, 6, 7% or whatever it is, because at that point, you're well beyond your fixed costs, and so the operating margin is so high, you're okay with giving some of the economics, but just negotiate. If you have to give into that, just make sure your break point's high.
Yeah. And as it relates to breakpoints, and we've seen kind of the other side of it. Yes, you're exactly right. Let's make sure that you've got the right breakpoints and the economics make sense, because you might be inheriting a space where that is the precedent across that retail center. But is there a way for this to be looked at from a collaborative perspective and a true partnership? Hey, landlord, make sure that the place is clean, make sure that there's events, make sure you support me, because we both win.
Yeah, there's a way to make it work, but you're going to have to run the math. I mean, if I'm going to entertain a percentage rent, right? For me, the break point's high. Okay, there's a couple things that have to happen. The break point's really high, or the base rent is low, right? So if the base rent is low, right, maybe it's under market, but there's a percentage rent factor, then it's like, oh, we're kind of in this together now, right? There's actually a partnership where they want to see me do well. And a lot of people say that, right? But that's actually kind of showing you that they want to do it.
Yeah.
And then Todd, you kind of hit on some of the ancillary items where they can kind of provide value, as long as there's accountability in the lease, like saying, hey, we're going to run X amount of events per year. You can participate in every single one of them. Just can't be gray. They gotta, hold it, hold very concrete items that they're going to adhere to and get them done.
Wonderful. I'm glad that we dug into that. So thank you for that question from our audience. So you talked about accountability, you talked about partnership, and maybe this is a good segue into all the different brands that you have, and I'm not going to ask you to stack rank which franchisor system is the best, but certainly the dynamics, I'm sure that you have as a franchisee, Dave's Hot Chicken, let's just say as an example, what's their spirit of collaboration and partnership to help you succeed?
Yeah, so I don't like in some brands I've sat on the franchisee advisory council. So specifically with Marco's and European Wax Center, I've done that. I still do it at Marco's. Specifically on Dave's, they do have a franchise council, so I know there's a lot of collaboration. Dave's has a phenomenal management team, and they're really on top of pretty much everything. What's neat about Dave's is a lot of their emails are very, hey, we're rolling this out, and this is the why we're doing it, and it's going to make you money because of this. And so look, they could be wrong, but a lot of times they're not. And what's neat is they just provide that level of transparency. So there is that type of kind of collaboration, and it's helpful to see that in brands.
Yeah. Well, and they certainly have the rock star musicians kind of as part of that too. And it's very cool to see how those superstars, if you will, are also embracing the brand, which is great. I mean, between Usher and Drake and the like, it's kind of cool.
Yeah, and I think some of those guys you mentioned, maybe not all, but are invested at the franchisor level, but also at the franchisee level too.
Right, right. And then Marco's. Marco's has been around for a long time. I think they were like number one or number two from a pizza taste perspective, at a national level. Some really good kudos to that team. What do you see as innovation from the Marco's brand?
Yeah, I mean, pizza is one of those products where you're in Marco's case, they're the fifth largest pizza brand, and so they're continually and they're growing. They're capturing share every single day.
Mhm.
But this is one of the brands where you have to have just a phenomenal product pipeline. You have to have the next gimmick product, right? That you can market behind, that you can put POP posters up in your stores and get people behind, whether the product's good or not. That's somewhat irrelevant. It's more about getting eyeballs on it and making sure people think Marco's Pizza right top of mind. And so Marco's, has different committees, and they have call it the kitchen cabinet committee that meets, and I'm on that one. We meet once a month and talk about what's the next product that we need to come out with. And so there's a new product coming out in actually a couple of weeks here that will be pretty interesting. It kind of goes with I don't know if I'm allowed to say. So
No, no,
it,
no, I'm not asking you. So just
it'll be a good product that comes out that'll get people talking.
well, cool. There's a few more questions that are coming up. Some might kind of go back to a little bit earlier topics in the conversation. What keeps you up at night as a multi-unit, multi-concept operator? I mean, you seem very calm. You seem very much like, I'm sure it's, often
Yeah, a
night.
lot of people say I'm calm, but I think what goes on between these ears is very intense. So
Yeah.
the intensity is pretty high inside. But what keeps me up at night? I mean, I think making sure that I've got enough growth for the team that that's kind of on this ride with me. I want to make sure that they're always motivated and excited about the next year and the next 2 years. So we're always looking to add a brand or grow within the brands that we're in, because I think growth is what gets people excited, and there's a lot of brands out there that don't grow.
Mhm.
And so just even having that perception that the next few years are going to be very challenging, very exciting, and having, they have a lot of opportunity to grow, whether professionally or through the org chart. And so we've done a lot of that since I've joined franchising, is just grow. And so I think people are always excited about that. So if
Cool.
I lose sleep, is just, not finding that opportunity to grow.
Got it. Got it. Very, very helpful. Four themes to kind of maybe choose from in terms of like systematizing your real estate, your portfolio, and your acquisition strategy. Are you looking at a system, lease cake or otherwise? Are are your goals really more about compliance, being more efficient, reducing your risk, or focusing on growth? Are you able to kind of stack rank those?
Yeah, that's, I mean, when I heard you say that, I'm thinking all the above, but,
Yeah.
um, reducing risk is very important to me. To the question, now that you bring that up, to the question, the participant asked about what keeps me up at night. Like losing a lease keeps me up at night. It used to. And so when I think about like reducing risk and maybe say compliance, right, is making sure that we actually have a lease that's
Yep.
in place, ready to go, and then reducing risk after that is very important. And then saving people time, my team, so that they can focus their energy and time on something else, and more strategic thinking, is important. And what was the fourth?
Fourth was growth,
Yeah, growth.
systems and scale.
I think if I do all those three, growth just comes, right? If I can save my team time, right? They have more time to think about, hey, we ought to think about these acquisitions up here or whatnot, because we have the infrastructure for growth. Building that infrastructure before you grow is very, very important.
Oh, for sure. No, that's helpful. I mean, efficiency can mean a lot of things, right? Reducing, uh, spend, using your resources more wisely, saving time. Think there have been studies where knowledge workers, if you will, I mean, people that you depend on every day, 20% of their time. That means 1 day out of 5 days a week, 1 day out of 5 days a week on average is spent looking for information that already exists or recreating it. And I think, frankly, we are still, as a whole populace, in business. Did Cal text me? Did he email me? Is that on Google Drive? Where is it on Dropbox? So all of these things are coming at us so fast. You need a system, and I think you nailed it on the head. It's like once you have something, you can save time, you can be organized and have compliance and reduce risk all in one fell swoop. But we're everyone's faced with this. And I think the smart ones like you are the ones that are getting one step ahead.
Yeah, absolutely. I mean, I think if you don't have systems in place, don't even think about growing, because the minute you go from like 1 to 5 to 10 locations, you hit certain inflection points and you'll get caught with your pants down, right? There's going to be a time. I mean, I have a buddy, a very close friend of mine. The nightmare that I just told you about happened, and he lost his lease, and it was a 50,000 a week pizzeria, independent, and think about the economic value that was destroyed because of that. I mean,
Oh,
a Chase Bank took over the location.
oh, that's exciting.
Yeah.
We've heard of stories like that, but it's tragic. It's not only tragic to the operator, but you think of the families that I'm sure depended on that location. It became part of their family tradition every Friday night or Sunday after the games. Like just all of a sudden, there's a bank. Like, and where did he move to? Across the
Yeah.
street, people can't find him. That equity, right? That value, that cachet that you built up is now lost forever. So I'm so sorry to hear that,
Yeah.
but it's not uncommon. Yeah, Vail Resorts took over a mountain because Park City forgot to renew their lease on a mountain range. I don't know if you,
Wow.
I
I
don't,
didn't know about that.
I didn't, yeah, it's public. It's all the rage. It's been around for a long time. Case after case, lawsuit after lawsuit, until finally they just lost it. So anyway, well, I'll share with you the blog post. Share with the audience too. There's a blog post on our site. Yeah, wild. So great kind of entire story arc. The fact that you're growing, you are looking for efficiencies, reducing your risk. What's some of the best advice that you've heard in your career that have made you who you are, Cal?
Couple things. Always take care of your team.
Yeah.
I think finding the right team members, uh, taking care of them, making sure that you appreciate them for every single thing they do, is it's a different philosophy than what maybe our parents kind of grew up in, but I think in 2024 it's really, really important. Um, I think if you, but I think that whole adage worked back then too. I just don't think it was as relevant. But I think now, what I might have went through on Wall Street wouldn't fly in 2024. And so it's important to make sure that, every single person they work for, you appreciate how hard they're working for you, because they have so many other choices. Um, and so I think, do we do a great job at that? We can always get better. Um, and what else is good advice? I think as you think about every stage of your company, I think you need to think about do you have the right team in place for the next stage, right? Am I, Cal, the right person to take a 50 unit portfolio to 100? Like there's got to be some self reflection there as well. I think that Reed Hastings talked about it a lot, right? What took him from say $1 million in sales to a billion, he had different teams and he made sure that he had the right team for the next stage, right? So we're always making sure that we have the right players in place and we appreciate them, the ones that we do have, as often as we can.
Wonderful. Great advice. And I mean, you shared advice to others. Is there any one little nugget or story of something that you took away when you were super young that you just stuck with you, or was it those two?
I think you hear a lot about being this is simple, but nothing mind blowing here. But like before I got into business, you'd always hear the story of being small business owners failing because they didn't have enough capital. And I think this is very relevant for VC. I mean, pretty much anything. Just make sure you have enough capital to weather the storm, right? And I think right now it's more relevant than ever because a lot of franchisees or even small business owners in general are in a big cash crunch, right? You have elevated costs, you have maybe sideways or declining sales, and so there's a margin compression happening right now. Not to mention if you have any debt and you have a variable rate a loan, you're getting even more compressed. So it's just making sure that when you do get a cash windfall that you hold on to it, and or you're very prudent with your balance sheet, right? I've made this mistake many times. I still make it because sometimes I want to grow faster than I should. But it's maintaining that whole adage of making sure that you're overcapitalized versus undercapitalized.
Mm-hmm. Words well spoken from a Wall Street expert who decided to open up a burger joint, right?
Yeah.
I mean, you've got story after story, and we could go on forever. So let's see. Any other questions from our audience? We covered lessons learned, mistakes made, size of the team, growth strategy. So recap: you've got Marco's Pizza, you've got Biomed Spa, you've got Dave's Hot Chicken. I've missed a couple others. Just want to do a quick recap.
Restore Hyper Wellness.
That's right.
Still a owner of European Wax Center and former owner of Orange Theory Fitness.
Wonderful. Well, we are so happy and humbled to have you part of our webcast series entitled Mastering Growth Strategies for Scaling Efficiently through Acquisitions and M&A. And if you haven't learned anything today, I don't know if there's any hope, because this guy, Cal Gulabali, is a master of all of that. And we have so much more to learn from him. And obviously, we are here as LeaseCake to learn and improve. What advice would you give me as the founder of LeaseCake? What are the things that we can do to improve here as we come close to wrapping up?
Yeah, I mean, I'd say just continue to lean in on your customers. Make sure that you're innovating, making sure that the products are what the customer needs, right? And don't lose sight of the customer, because we're what drives your company, right? And like I said earlier, take care of your team, because they're the most precious asset to the future of LeaseCake and all of our companies.
Thank you very much, Cal. Really appreciate it. Before everyone goes, we have a couple other episodes coming up. So you talk about replacing yourself. You talk about building, this preparing for that next stage. On June 12th, we have exactly that. A Duncan story around how Inspire and franchisees and franchisors work together to help build legacies. Because I think, frankly, that's what you're doing, Cal, is creating a legacy. So coming up on June 5th is ACEs for a pickleball, journey of their growth, as well as the June 12th webcast that's coming up. So we look forward to having you join for that. And for those who weren't able to attend, We will be sharing this webcast live, and you can watch it at your leisure. So we definitely encourage people to register. And if you can't make it live, that's totally fine. But Cal, any parting comments as we wrap up?
No, thanks, Taj. Thanks, Michelle. Thanks for having me on, and I appreciate the dialogue.
Absolutely. Well, we'll see you soon. We'll be heading over to Tampa, I'm sure.
Sounds good. See you soon.
Take care, Cal. Bye-bye.